Hello everyone. Today is Tuesday, February 27th, 2024. My name is Mark, or some refer to me as Blunt from Blunt House Technical Analysis. And some of the people in our group have been asking, why don't you do YouTube videos? Why don't you do TikTok videos? So here we go. We're going to do a YouTube video, and I'm going to wing this, and perhaps we will do some more. But I want to talk to you about what Blunt House Technical Analysis is not. I am not here to tell you where I think Bitcoin is going to go. I am not here to tell you about what the latest narrative is around crypto. I'm not here to do any of that. I have one goal, and that's the one goal of Blunt House. That is to teach you how to read price on a chart. To take the intimidation factor away from markets, to demystify these things a little, to uncomplicate them, and to help you understand that technical analysis is the language of the market. It is a real-time representation of what money is doing, not what people are saying. And the only thing that matters is what goes on your chart. The chart has a way of telling you how it's expressing itself. Is it bullish? Is it bearish? Does it have momentum? Does it have too much momentum? All of these things it will tell us. And we also have to understand that current price revisits past. So in the event of a downtrend, price on the way down will be looking for past price. And we're going to talk about where to find entries into the market and ultimately how to make safe, profitable trades. That's what we really want to teach in Blunt House. So without further ado, let's talk a little bit about, and we're going to start with Bitcoin. Again, I'm not here to tell you where I think it's going, although technically that's a conversation we can have. But I want you to understand what you're seeing on this chart. And quite simply, you have a volume profile, which is what you see here on the right-hand side. And obviously you have candlesticks and two averages. And in this case, they're exponential moving averages. The white is the 5 EMA, and the yellow is known as the T line, or the 8 EMA. How simple is that? Three things on your chart: the 5 EMA, an 8 EMA, and a volume profile. And this amber line, if you're asking what that is, if you're unfamiliar with the volume profile, it is what they call the POC, which stands for point of control. And what that thing is doing is it's averaging out benches of past price. And you can see that's what it's picking up here. And then of course it has a look back, and you can adjust the number of days that it reads. But that's what it's doing. It's picking up past price. And you can use this on any time frame. The daily, the weekly, the 4 hour, the 1 hour, the 15 minute, it doesn't matter. And what it's identifying for you, and this is important because we're going to get into this in a little bit here, and this is only going to be about a 10-minute video. These are volume gaps. These here that you see are volume shelves. And price will either sit on a volume shelf and then propel itself into the gap, where it takes a pause again because it's found another shelf, which is a representation again of past price, and it takes a little time to chew a lot of that up, and so on and so on. And why this is important is because what you'll find is that you can actually trade, regardless of the time frame you're on, in and out of the shelves into the gaps, either up or down, quite easily. And why I have the 5 EMA and the T line up on this chart, quite simply, is because it's a way of showing you how to enter the market safely. And for the sake of our conversations here today, we're going to assume that, because context is important, that everyone's trading spot. All right, we're not talking about adjusting stops because of liquidation levels and things like that. We're talking about spot trading, or in the context of spot trading. All right, regardless of the type of trading you're doing, the technicals still apply. But what I want to show you on this chart, quite simply, are a few little things. And let's start with the basics. The question we get in the Telegram chat all the time is, when do I enter a trade? When is it safe? When is it not safe? How do I know if it's a good time to enter? How come the market turns around on me as soon as I enter? All those types of things that, we've all experienced at one time or another. So one of the little tricks I've learned over the years from various different people is how to trade the T-line. And one of the methodologies is quite simple. When the 5 EMA crosses up through the T-line, which is the white crossing up through the yellow, that is your indication to take a long trade. And how long do you stay in the trade? Well, as long as there is divergence between the 5 EMA and the T-line, as you can see here quite clearly, and even down here you'll notice that the divergence, although it narrows, it doesn't break. So as long as you have that divergence between the 5 EMA and the T-line, you can stay in the trade. It's the market's way of telling you, although the roller coaster feels frightening, it's the market's way of telling you it's okay. And the idea is to get you in the driver's seat early. That's what we want to do. We want to get you in the driver's seat early to get ahead of the trade so that you don't have to be having living nightmares about when to exit. So, real simple. 5 EMA crosses up through the T-line. That's a bullish signal. Boom. Divergence between the two, you can stay in the trade. You'll see you go sideways for a while, but again, you don't have a break. The divergence maintains, and then all of a sudden it opens up again when you get, I'm going to call these parabolic moves up, because they are. And what you can take away from this type of divergence is that there is momentum in this move. And that momentum you can also see is obviously in the candles, right? Sideways price action, what happens? The 5 EMA and the T-line narrow, or the distance between narrows, which tells you that price is tightening, but it never did break, right? So that's one simple thing that you can do real easily, very easily, to make a safe, profitable trade. Now, if you wanted to short the market, what's a short entry? Well, a short entry would be, and again, if you're going to be shorting, you're obviously going to be using some margin, but for the sake of our conversation, let's say you're using the absolute minimum, whatever that is on the exchange you're on, and you have the 5 EMA crossing down through the T-line, that is your short entry. When you take your trades off is going to be up to you based on your own trading plan, and that's a whole other conversation. But what I want you to understand is that you can enter and exit the market safely. Now, one of the other little elements that you can add to this analysis, and there's three things that you see here. This is a Connors RSI, or known as a CRSI, and I think it's basically a 232 or 322. It's a quick moving RSI. This is a stock. When I say stock, I mean it just comes right out of TradingView. This is a stochastic RSI, and this is a MACD. I have not adjusted any of these three indicators whatsoever. But what you can also do to help you determine when you are making a good entry is you can look for, well, in this case, if we go right in here, you can see, although you can see this big red candle cuts through the T-line and the 5 EMA, this previous candle showed you that you were overbought on your stochastic RSI and you got a sudden divergence down. Because understand, this is what you would be looking at if you were to see this on your chart, right? And you can see that there was divergence in your MACD, divergence in your stochastic RSI, and you had a bit of an impulse candle up before the pullback. That little impulse candle up or down is usually a signal that you might be near a reversal when these other situations kind of line up. The Connors RSI, because it moves quick, it's going to pick up all these sudden moves, but I like that for different reasons. But nevertheless, you can see by adding those overbought stochastic RSI, it helps give you a clue. All right. Now, if we were to shorten this time frame up a little bit, all right. Now you can see this is a 4-hour. If you were trading this time frame, what you're going to be looking for is You don't want to trade chop, right? We tell them in the group, don't trade chop. You want to trade breakouts and breakdowns. That's all you should be interested in, right? This stuff is all BS. You don't want that. You don't want to trade it anyways. What you're looking for is coming out of this if you're looking for trading moves. And you get that signal in here. You get lots of them, right? But you don't want to trade the sideways stuff. You want to see when it starts to break out, when that divergence appears, all right? And you can trade it up, and basically you can see what's happening here. This thing has staircased its way up, right? Here's your POC, the point of control within your volume profile, which is showing you this big bench of past price. And these benches of past price also become draws for price in the event of these moves up and moves down. Right? So in the event that we start to roll over here, and what would we need to get a sell signal or an exit signal if you were long spot? You'd want to see the 5 EMA cross down through the T line, and you'd be looking for a close below the T line as well. And what that's telling you, when you start to close below the T line, that the probability of that move continuing to go higher has dropped. That's basically what it's telling you. But if and when it does roll over upon a retrace, this becomes a draw for current price. Current price revisits past. It'd be looking for that on this time frame. All right, and everything, again, the context is important. Everything is relative to the time frame you're trading it on. Now, are there any other little things that we can do to try and make this a little easier for us to read? And the answer is, yeah, we can. So what you're seeing here, and I want to make this clear, these are entry signals, long and short only. They are not exits. They are entries only. So this script I prepared, and it helps me identify when price might be breaking out. So we talked about not trading the chop. So when you see the chop, you're going to see all of these little things changing colors quickly. You might only get a candle or two window for up or down price movement, and as you know, because it's chop, insignificant in its movement anyways. What you're looking for are these moves. So you can see here, coming out of the chop, you get a signal. Now in this case, it's really hard to see this, but in this case, you know, there really wasn't much going on here at all, and you finally get a signal, and geez, you know, you could have, this big green candle here probably would have got your attention, and that's the insurance you would have paid for being right. Right, so whether so you didn't enter here, you entered on this, big deal, or even if you entered here, who cares? Like, look at the move, nice long move up, and then what happens? You base out again. You don't want to trade the flat stuff, and you don't want to hold in here either, because as you're holding, it's just exponential risk, because you really have no way of knowing one way or the other where price is going to go, and you don't want to get caught on the wrong side of it. So you could easily enter these areas if that was part of your strategy on this time frame, and wait to re-enter or go short into these gaps, right? So price has two choices. It's going to go sideways, it's going to go up, or it's going to go down. Pick one. And it's our job to make sure that we're more often right than wrong. And there is no prize for being early. Technical analysis is not about front running the market. Technical analysis is about making safe, profitable trades. Look at it as a risk mitigation tool. So by adding this script, you can see in here we get an entry signal, and a price takes off again, coming out of a base of consolidation, moving up into the volume gap, coming off a shelf. The longer time frame that you trade, you're going to find that you need to, if you're using leverage, use a lot less, because you don't want to be a victim to the whipsaw. But what you're going to find here is that even trading spot, these are real nice moves. Like, this is a trader's dream. These are real nice moves for you to pick up. There's your T line, 5 EMA crosses up, you get an entry signal, and price just rides up. And you can see how it respects these levels. Price does not break. You get a close up here and then another parabolic candle. I would be having, on my regular chart, I would probably have some moving averages here to give me an idea of what I am finding support on. My guess is you're probably going to find the 20 or something like that up here providing support. And what's happening is that you're getting a continuation off the 20-day moving, well, there you go, off the 20-day moving average, right? So what you'd be looking at is, oh, okay, so we went sideways. Notice this, price went up and it went sideways. It did not retrace. So when price rises like this and it goes sideways and finds support on the T line, that's either an opportunity, it's really an opportunity to add. And that's how I would look at it. And then you get a move up and you get another move sideways. And this one finds support right on the 20. And then you get a big candle off there. Another sideways move, except this retracement caught the 20 yet again. So these are what I would just be referring to as, continuations off the 20-day or 20-day continuations. That would, the next would apply to the 50 and so on. But price is always touching something. When you start going sideways, that's where you're going to get chewed up, and a trader doesn't want to be there. You're waiting for your next nice opportunity. The problem for many traders, even experienced ones, is respecting the amount of time it takes for these moves to materialize. So, these are 4-hour candles. There's several days in here. So you have to be able to be patient for several days to wait for your trade to materialize. And sometimes that's an easy say and a hard do, right? But we don't trade the chop. We're really looking for the breakouts and breakdowns. And again, if we pull up some other indicators, what do we have that line up with our entry signal? Well, look at our MACD is taken off right from the 0 level. Our stochastic RSI, bullets down and is snapping back up. And your RSI obviously picking up that big sudden movement down and then this big shot and price up. In all of these indicators, stay elevated, stay overbought. And traders believe, oh, I got to trade every cross. No, you don't. You don't. Especially with a stochastic RSI, right? It has a tendency to either, drag the bottom of the ocean or scrape the ceiling. And when it's doing that, it's basically telling you that the buyers and or sellers are sticking around at those levels, in this case, the buyers. But when it does break down, because of this move was somewhat parabolic and it went through a volume gap, it would be significant. Right? The pullback could be significant. And that's one thing that happens in these big parabolic moves up and down, everybody, is you have to be prepared for the whipsaw on the way back. Throw some Fibonacci's on your chart and you'll see what I mean. If you're looking for a typical 618 level, you're going to be amazed at where it might show up. Right? This script here is available to people who want it. In our chat, I suggest you come into our Telegram group. I personally trade on MEXC and on Blowfin. So when you sign up with either our affiliate link on MEXC or Blowfin, the script is yours for free, and you simply load it into your TradingView charting software through the Pine editor, and boom, there you go. It is yours. So it's very simple, but trading was not meant to be complicated. And when you speak to, I had the benefit of learning from old school traders, and one of the reasons I respect them is because even through all they've seen, they keep everything incredibly simple, and that there's no need to make things complicated. You have one job as a trader, and that's to monetize the chart. Our job is to help you make safe, profitable trades, and to help you understand that technical analysis is the language of the market. This is not about what people are saying. It's what money is doing in real time. So that's where I'm going to end this for today. If you would like to join us in our Telegram group, please feel free to do so. And I will provide a link for you. And again, we will also provide links to MEXC and Blowfin for those who want to trade with us there. We welcome that. And we're going to do this again, and I really want your feedback on these. So please feel free to message me, join our Telegram group, and send me messages there. We're active in it all the time, where we also hold live sessions as well. So I look forward to seeing you soon, and have a great day.